Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Financial markets have really evolved over the years as markets move quicker than ever. And this has resulted in new dynamics for investing as correlations between historically low correlated assets have increased, which makes building diversified portfolios more difficult. But that's resulted in new investment products and strategies. Well, I have on an industry expert to share his insights into some of these new investment strategies in the modern approach to diversification. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and get started and move on to the star of the show. I'd like to give a very warm welcome to Zed Francis. Zed is the CIO and co-founder at Convexitas. Zed, thank you so much for coming on the show. It's an honor to have you on. We've talked, I had a few conversations before this, great conversations. I'm really excited about this one. It's going to be a good one. Can you please tell us a little bit more about yourself and Convexitas?
Yeah, of course, Ryan. And thank you so much for having me. And I have to say, you're living in basically my favorite place in the United States on the South Shores of Lake Tahoe. Even so much that, the internet knows that I love it because I get like the Reddit stuff of everything coming up for sale. And one yesterday in Zephyr Cove, I saw listed for $200 million. So I hope you've been saving your ducats to go ahead and get that new house down the street from yourself.
Yeah, there you go, Zed. I mean, perfect for you. You got your little cabin, get a second home on the lake. That would be fantastic. And real quickly, I'm glad you brought up Zephyr Cove. The founder of Zephyr, he founded Zephyr on the shores of, he had a house on Zephyr Cove, and he started in his garage 30 some years ago and called it Zephyr.
It's hard to find a more beautiful place than that.
There's worse places to live, Zed.
That's right. Well, transitioning to your original question. Yeah, Zed Francis, current co-founder and CIO of Convexitas. But my career, I've been on the buy side for a vast majority of my career, kind of starting long, short distress hedge fund during GFC, which was a fantastic experience for that style of strategy during that kind of market dislocation type of period. Wandered to international asset manager, one of the big guys, did a quick swing through a boutique volatility asset manager, and then ultimately 5 years ago founded Convexitas. And my business partner and co-founder, Devin Anderson, actually mirrored myself for a vast majority of our career, but him being on the sell side. He started as on the sales trading division, and by the end of it was running their solutions and structuring desks for equity derivatives. And ultimately, through those mirrored experiences where we worked with each other through those kind of 15-ish years on opposite sides of the coin, came to a very similar conclusion. And ultimately, we viewed that the taxable investor were not being delivered efficient derivative strategies. And what we mean by efficient is either folks were not providing high investment efficacy strategies and what we viewed as the correct wrapper, the correct operational structure, or they were doing a great job on the operational side, but were more implementing option strategies on a treadmill rather than necessarily good investment strategy. So we founded the firm to do that mix, like really hedge fund quality investment strategies and what we view as the correct operational wrapper.
Fantastic. That's interesting with your partner. Do you find that really benefits the firm too when you got those mirrored experiences, buy side, sell side, really bringing them together in the fold? Probably gives you an advantage that a lot of other firms don't have.
Yeah, no, we know we'll call it soup to nuts plumbing, right? It's when the buy side person is looking to implement something or execute something, we know what it goes to that stage, and then he's like, I know what the market does then with those implementations to recycle that risk through the system. So it is very nice from both a a actual implementation of strategy, and then obviously knowing a decent amount of the players in the space for both sides of the coin.
Interesting. Good stuff. I love the stories at how people get to where they are today. Some interesting ones out there. I mentioned diversification. It's really evolved over the years. It's one of the fundamental strategies of wealth management. You learn about diversification in day one, right? And the importance of it. But like I said, it's evolved for numerous reasons. Diversification's harder than ever to get within a portfolio, especially when times when you need it most and crisis is happening, everyone's running to the exits, correlations increase. That's when you need diversification. But it breaks down. And it's been a drag on portfolios for years. It's like, why invest overseas when the S&P 500 is, reaching new highs and outperforming? What's your view on diversification?
Yeah, so I mean, diversification is kind of known as what the only free lunch out there is diversification, and that concept comes from, all right, if I have a bunch of return streams that over time go from lower left to upper right, i.e., positive
Yep.
returns, and they move in different directions over time, that surely does appear to be a free lunch. I have things that appreciate, they move in different directions, meaning that my overall volatility in my portfolio is dampened by owning multiple things. That certainly seems like a free lunch. But ultimately, it's not worked wonderfully over the last decade. And I want to say decade because most people are like, okay, we all know the year of 2022 was equities down, fixed income down. They tried to highlight that as saying, that was one of the obvious scenarios where long only diversification did not work. But it's been a pretty darn persistent problem. I mean,
Yeah.
recently, April 2020 of this year, 2025, during the stress periods, fixed income was not helping. It was actually hurting while all your risk assets were going the wrong way. In March 2020, during the meat of that crisis, pretty much it was everything was going down. There wasn't that really that help. And even during something that I would say is not exactly viewed as much of a crisis period, the kind of September draw and the December draw in 2018 had again asset prices moving in similar directions. So diversification is a wonderful free lunch as long as it actually works, as long as the squiggly lines are moving in opposite directions. Additionally, in my opinion, what the diversification long only, we're trying to mute the volatility and have things go up over time. To me, the true additional long term value add of diversification, if it's working for you as you expect, is the quote unquote, I would say the free dinner, and that's rebalancing. That's the rebalancing premium where diversification really accelerates not only the muted volatility, but actually potentially increases the long-term expected returns of your portfolio is when you rebalance. This is as simple as, okay, the stuff that's down, you get to buy some more. The stuff that's up, you're trimming. And so that works really well when things are actually diversified and moving in different directions. But you can only receive that rebalancing premium if that's happening, if they're actually moving in opposite directions, especially during times of stress.
Zed, I'm really glad you brought up that point about rebalancing and the benefits of rebalancing. At Zephyr and using Zephyr, I've done a lot of research in terms of what rebalancing frequency might be best in terms of performance and also considering turnover. You've got monthly rebalancing, quarterly, annual. And my thoughts is annual is typically the best, but what's your thoughts there on rebalancing and the frequency?
Yeah, no, that's a great question, and we definitely have a very specific theme of how we operate products, and that transitions into how we have a little bit of opinion on input on portfolio management, and ultimately that's risk over rules. So we're a big proponent of you should let risk actually drive the rebalancing process rather than a date on the calendar. And so a simple example is, 60-40 portfolio, say of a year where equities are doing really well and fixed income is not. As soon as you say maybe to get to 65-35, you're like, that is enough risk differential from our targeted. We should get back to home base and let that drive the bus rather than the calendar.
Yeah, that makes sense. It's a very good point that, you know, why does time have to play a role? Really, it's risk when your portfolio, especially now over the past couple of years, your portfolios are probably way overweight to growth and tech, and is that the risk that you want
Right.
moving forward?
Right.
So you mentioned, going long US and international equities and bonds, the 60/40 portfolio. It worked for a while, but now that's just not enough. Going long, everything, it just, it, like I said, it's not enough for today's market. Why is that? Why is that enough to be truly diversified? And is there a better approach?
Yeah, and so in our opinion, the issues with long only diversification, outside of potentially not working well when you need it most, and losing out on that rebalancing premium, because again, like you only get to buy low if something else in the portfolio is either up or providing you
Mhm.
liquidity to do so. It is we've gone to this point where markets tend to have these illiquidity spasms, right? It's less so, we'll call it fundamental drift of something's doing well, something's not doing well.
Yeah.
But ultimately we end up in these illiquidity spasms. And when there's an illiquidity spasm, it's less about I gotta sell risk or, hey, the flight to quality type situation. It's I need liquidity, which ultimately results in everything going down during these points in time, which at the same time is probably the worst potential scenario for your portfolio in terms of risk assets performing poorly. Those diversifiers are not helping. They often are hurting during those illiquidity spasms. So, our opinion is why it's actually important to have something truly negatively correlated to whatever your largest risk in your portfolio happens to be, which, for most folks tends to be, equity type risk, something that's truly negatively correlated so you can survive and actually be opportunistic during those illiquidity spasms rather than just kind of riding the train and being like, well, over time, I think this will recover, even though potentially my portfolio is going through a little bit of a problem.
Fantastic. Is there like another investment strategy maybe that, isn't, you mentioned liquidity that might help with liquidity during those times to give you some uh, powder on the sideline to take advantage? Are there some other strategies that maybe some people don't normally think of outside that traditional 60/40?
Yeah, so I mean, so our business again, we wanted to build something that was the correct operational wrapper and true investment efficacy in the underlying strategy that we're operating on behalf of clients. And our expertise is in the derivative space. So we trade listed equity options as part of our universe of tools to deliver these strategies. And so I would say most advisors, the most common experience that they've had in terms of option overlays or utilizing derivatives within their client portfolios is probably concentrated stock issues. I mean, that is proliferated around. That's probably the most common experience is, hey, my client has 90% of the net worth in a single name. We're going to hire a manager to de-risk that specific security. Okay. What we do is very much at a portfolio level, not at the single name concentrated issue, but from an operational standpoint, what we're doing is incredibly similar to that likely experience a lot of advisors have had.
Yeah, fantastic. And options with overlays are really popular now, but it's one of those things where just buying a call or selling a put, that's very easy. You have the condors and the, butterfly spread, all this stuff that is like I failed the CFA for a reason. And it's a lot of the derivative stuff. So having a strategy, a professional like you guys that, specialize in options is, they're good strategies. They're complicated. So let you guys do it. But there's different vehicles. You could do an active ETF and all these other vehicles that gain access to these overlays. What do you feel is the best strategy for, financial advisors to get exposure to some of these option strategies?
Yeah. So, but first off, is there's no like carte blanche answer that this is the correct vehicle for all things. It's very much what is the strategy? What is the tool? How is it going to interact with the portfolio? And then you do the structuring of what is the correct wrapper to put that type of tool into, right? So as
Okay.
I think most folks are like these days are like, ETFs are the greatest thing for everything. And you're like, that might be true for 60, 70, 80% of cases. That might be very much true. But There's other things that are much better delivered in a different style of wrapper. So out of the gate, we're very much correct tool, correct wrapper, rather than hammer nail. It's the same answer every single time.
Yeah.
For our universe and what we're trying to deliver, being a negatively correlated strategy, in our opinion, negatively correlated strategy should be only implemented in separately managed accounts and SMAs, especially when it comes to option related, negatively correlated strategies. And it's pretty simple of a waterfall. Why? So right out of the gate is funding. There is no reason to fully fund a derivative strategy. That is essentially the point of a tool of a derivative. It is collateralized by something else. You're coming to the
Yep.
table with a bunch of long market risk assets. Negatively correlated strategy using derivatives, sits on top very nicely. There's no reason to cut a check at any point in time. The no reason to cut a check is very important outside of being very collateral efficient in two other ways. First, there's no day one tax implications. There's no switching costs. You don't have to say, hey, I need to sell something to buy something else, and the things that I
Yep.
sell likely have very low cost basis. You completely remove that. So you can adjust the risk of the portfolio with zero day one tax implications. The second piece of it is if it does not need funding, your current assets support this new ballast in the portfolio, it means you can think about portfolio construction a little differently. It means your cash allocations can be a little bit more risk forward taking because your ballast, your diversifier in the portfolio is unfunded. So rather than having a 60-40, we'll call it portfolios that has a lower risk profile, you could be 100% equities with a derivative portfolio tamping down the risk to look something like a 60-40 portfolio. So very valuable both from day one tax and in terms of giving you massive flexibility to take more risk with the cash allocation. The next piece of that is rebalancing. Okay, like common theme of our talk so far, rebalancing. So in my experience with negatively correlated allocations is the behavioral issues with rebalancing are problematic during times of stress. So, very simple. Hey, I got something that is meant to be long risk. I've got something that's meant to be short risk. Some nasty time in the marketplace happens. Everything does its job. The long risk thing's down, the short risk thing is up. Taking that action of actually selling the only thing that's up in your portfolio to redeploy it and everything that's down in your portfolio freezes people. It's somewhat difficult to keep that on a consistent treadmill. When you deliver a negatively correlated strategy in a separately managed account that's actively managed, then all of a sudden that's just unencumbered cash sitting directly there in your client custodian account. It's much easier behaviorally to that second week of April of this year to say, hey, my normal cash seat for this client is 2%. Everybody's done what you've expected, done their job, and now cash in that account is 7, 8, 9, 10%. I am now actually out of bounds having that much cash in the account. I have to rebalance to get back to home base. So delivering a negatively correlated strategy in the separately managed account, behavioral makes it much easier for everybody to stay on the tracks and actually do that rebalance into risk assets during those times of stress and view that actually as an opportunity. And finally, massive tax benefit implication. So when you have your long asset portfolio and your short, your diversifier portfolio all in the same, house, essentially, like custodial account,
Yep.
it's essentially creating a long short portfolio of one. And without getting like too embedded into it, if your long short portfolio all in the same place, there's always a source of gains and losses, allowing you essentially perpetually do traditional tax loss harvesting. The portfolio never ossifies. And all of these things between having it be unfunded, allowing that to increase the amount of underlying risk taking in terms of the cash portfolio, and making rebalancing more of a standard process rather than some sort of hero ball. Is this the time I sell that thing, buy that thing? Nope, we're just rebalancing a home base, and improving the tax outcome can only be delivered in separately managed accounts. So again, like it's the right tool in the right wrapper is very important.
That's a great point, Zed. I'm really glad you brought that up. You know, Active ETFs are popular. At Zephyr here, we have the PSN, separately managed account database. So I'm obviously biased, and we're big proponents of SMAs, but everything that you said about the tax efficiencies, taxes are becoming so popular now, such a topic. And then transparency, right? It's so important now. People want to know what they're invested in, and rightfully so, they should. Mutual fund, tough. ETF, better, but separately managed accounts, you can, yeah, direct ownership, all the benefits. So great explanation there on it. So then let's talk about, for a financial advisor, how can they implement a strategy like this? Is it something where it's like a core strategy where, you got some risk mitigation that's uncorrelated to the other assets, or is it, something where you use as a percentage of maybe the, S&P 500? How do you use it in a portfolio?
Yeah, so I like to say like the waterfall of how an advisor onboards our solution is a little bit of an interesting walkthrough. So standard client number one for an advisor, where they say, I've looked at a lot of things, and what you guys are talking about seems unique and differentiated for this problem that I have. There's usually 65-year-old end client. They're up to 90% equity exposure simply because they did the right thing. They deployed it. They deployed their savings into the market. Guess what? Equities have gone up. So they're in this seat of probably over risked if you have a clean sheet of paper of where they should be at 65. And every time the advisor has a quarterly catch up with this person, they discuss saying we're probably a little over risk for where you are in your life, but all the solutions involve a tax bill ultimately to rebalance towards where they're supposed to be. Well, we can come in directly out of portfolio, zero tax implications day one, and just be that risk dial. Get them to the risk seat that they're meant to be without any frictions out of the gate. That tends to be experience number one. Now, you get a yen carry trade crisis, sneeze, or what took place in April. That's when the advisor says, oh, okay, like I understand why this is valuable for that client number one situation. But
Yep.
now that I've seen the ability to rebalance into a portfolio that I want this end user to be in during these times of semi-crisis, I think it's strong to say crisis for either of those, but those sneezes that took place in the market, this diversifying strategy provided actionable liquidity for me to go ahead and rebalance into a portfolio I want them to. That's a very useful transition mechanism, but it's also a very good communication tool because that end client is saying, oh, geez, like the market is having some problems. How are we doing? And the advisor gets to say to them, not only are you experiencing less of a downdraft than you otherwise probably thought, we actually have liquidity. So we're putting together a shopping list. We're flipping it on, it's on its head to say we're being opportunistic during this time period, which is probably a good long-term investment situation to, be a buyer when everybody else is sellers, but also is a great communication tool to their end clients. So that tends to be like, okay, when advisor goes from, situation number one to, oh, I got 2, 3, 4 clients where this type of messaging is really appropriate for them. And then after they get through 1 or 2 tax seasons where they say, wow, our equity portfolio is up. There's positive returns. And yet the equity portfolio has distributed usable losses to counteract tax bills on bonds, real estate, things along those lines. They say, wow, as a tax tool, this might actually be useful for clients, 5, 6, 7, 8, 9, 10. So ultimately, there's enough moving pieces and enough changes of standard processes of using something like this as a portfolio construction tool. Well, once the advisor sees it in action, has those communications, ultimately they start viewing an involvement as something like this within their portfolio manager process as a prospecting tool. This is a differentiating process for them to look for these types of clients to grow their business because they have a unique solution that allows the advisor all these actions. Because everything I said, like my seat is to provide a tool. I'm trying to be an expert in one thing, But that tool, if applied correctly, it allows the advisor all these opportunities of creating that risk style and changing how they think about cash allocations, allowing the advisor to redeploy capital during these types of situations where there's market sneezes, allows the advisor to implement tax loss harvesting in a better way over the long term. So, describing again what we do is a tool, because it very much is. It's allowing the advisor to garner these additional opportunities, both for the current client base and then also as a differentiator in prospecting.
That's fantastic. It's such great information there for financial advisors. I talk a lot on the show about how, that space in wealth management, financial advisory, it's so competitive. And you said it, like, using a tool like this can help differentiate your practice from others who may, that aren't offering similar products or similar tools, like you said. So it's a great way to differentiate your product or your practice from others. So a strategy like this, sometimes, now you've got these buffered products, all the defined benefit product contribute or not contribution, but outcome products. Sometimes it can be a little bit drag on performance, right? They're trying to limit those tail risk events, limit the tail risk events, but on the upside, you might kind of lose some of that upside capture. When you're talking about a big portfolio here, is there like another corresponding strategy that might be able to give the portfolio a little more juice that works well with this strategy?
Yeah. So, I mean, we're going to honestly bucket these in very different conversations, to be honest. To me, our flagship strategy that is that portfolio level diversification tool allows you to take more risk with the underlying cash assets, allows you to accumulate more assets during market draws. Those are the types of things from a holistic portfolio level you should use to essentially add more juice when you have this unfunded diversifier. But we do have another strategy that is very different sounding, incredibly different sounding than anything we've talked about to this point. And ultimately, why that's the case is how we think about building strategies is way less to do with, oh, these are the, things we would like to sell to the end user. It's more so, where do we see mispricing in options? Do we
Okay.
see that mispricing as structural, i.e., something that's going to be here for a long period of time rather than just a flash in the pan? Can we structure these mispricings in a relative value framework where we're buying something and selling something rather than just on one side of the trade at all points in time to build a more robust strategy? And then can we package this in anything that anybody would care about? So the product is the very last step. And so that's how we ended up with, two strategies that are operating that are very, very different. And the one you're alluding to is we have a sector replacement strategy. So if a client is already interested in owning semiconductor exposure, which is now up to almost 14% of the S&P 500, so a meaningful sector in the overall portfolio, we believe we have a better way of accessing that allocation to that sector utilizing options. And the thumbnail version of that, of how we look to implement something like that, is it is a short dispersion strategy. End of the math lingo. We are selling volatility in single names because single
Okay.
name volatility, especially downside single name volatility in that sector, is expensive relative to what we would say is theoretical fair. And we can identify why that's likely the case, which is as simple as it is a sector that has produced a significant amount of wealth for current employees and past employees. And so they are in that seat of concentrated wealth in those names.
Mhm.
And thus, they're looking to de-risk that single name without paying tax or a significant amount of tax. And they
Yeah.
all happen to be, for the most part, in a very high tax state. So the friction is even greater to sell those securities to go buy a house and so on and so forth. So there's a lot of, whether it's, variable prepaid forwards, whether it's just using liquid options, the collar, there's a lot of strategies that folks are utilizing to go ahead and de-risk in single name position and borrow against that asset to go ahead and buy their house or things, so on and so forth, that ultimately make downside volatility in those names very expensive. And on the opposite side, index options are inexpensive because a lot of people do overwriting of the index over they're restricted. They're still an employee of,
Yep.
who's reporting today after close NVIDIA. They're still an important, employee. Well, how they can't trade NVIDIA options. They have to do something else. So there's often a lot of overwriting programs in the index. So long story short, single names expensive, index inexpensive. We utilize those inefficiencies to create a sector replacement strategy, ultimately of the goals of one-to-one downside better than one-to-one upside. So if that's a sector that's of interest, we do think we have a better way to garner additional upside from this mispricing in options and as part of a sector replacement style strategy.
Yeah. Wow, is that fantastic? And so all those people that might be selling a product or to buy a house, there's that $200 million house just down the road in Zephyr Cove. There
That's
you go.
right.
That such a fun conversation. You dropped a ton of great insight. I know the audience is going to get a lot from it. I know I did. I'm probably going to rewatch it a couple times, take some notes. Fantastic. Where can our audience get more information about Convexitus?
Yeah, so I think find us at our normal stuff. So our website is just convexitas.com, convexitas, or just find us on LinkedIn, either searching myself, Zed Francis, or our firm.
Fantastic. You guys you got a great newsletter. Highly recommend, signing up for that newsletter. Great information.
Appreciate
Zed,
that.
it's been an honor, a great conversation. Thank you. And thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe to those channels and follow us on LinkedIn. Thank you and have a great rest of your week.